Hey guys, Jeff Cook here today, and we want to talk about what is equity. The word equity comes up a lot, and a lot of home buyers, homeowners are still trying to figure out what is equity. And so today we want to explain exactly what that is to a homeowner or a potential homeowner. So what we're going to do is go ahead and just dive right in and get right on into it. So what is home equity? Home equity is the amount of the current value of your home minus the mortgage or the debt that you have on that home. Said differently, it would be how much you would sell your house for, what you would put in your pocket when it's all said and done. So let's do an example. Example of, say, I've got a home that's valued at $400,000 and I have a $100,000 mortgage on that property. The amount that's left over in that case would be $300,000 that I would actually put into my pocket and sell when it's all said and done. In that same example, $400,000 house, say I have no mortgage. Well, in that case, I would profit $400,000 when I sell it. So therefore I have 100% equity into that property. Now, we also have to factor in some closing costs if you were to go to sell your home. So an example of that would be the attorney fees and property taxes and real estate commissions and things like that. However, that amount is typically around anywhere from 5 to 8% of the value of the home. So you have to figure those things in as well, because you would not profit those whenever you go to sell your property, but the remaining profit is considered your equity. So I want to jump right in and talk just for a minute about how can you build your equity? So let's dive right in. And how do you build your equity? Well, the number one way to build your equity is just simply keep making your payments. There's an old adage that says, if you pay, you stay, if you don't, you won't. But separately than that, when it comes down to equity, the best way to do that is to keep making that monthly payment every single month. Because what happens in that regard is that the amount that you owe on the mortgage typically goes down over time. Said differently, let's say that I take a $250,000 mortgage out on a home. As I keep making payments, that $250,000 goes down every single month. The second way to build equity are upgrades and improvements on the home. An example would be hardwood floors. Maybe an area of your home has carpet and you add hardwoods, or maybe it's time for that kitchen renovation or new appliances that you've been thinking about. Or if I renovate the bathrooms or even put in a pool, all of those things will help build the equity of my home, because the value of my property is simply going to go up because it's now more desirable, because the bucket of features that you have on your home are now higher, and therefore the property could sell more. So an example there would be, I have raised the value of my home from $400,000 to $500,000. I still owe $250,000. I've increased the equity of my home up to $250,000. Another way to increase my equity is to simply continue living and making the payment on the home with appreciation. So let's say, for example, that I stay in my home for 3 years, 5 years, even 10 years. What will happen is the value of that home will continue to go up every single year. Now, over national trends for the last 50 years, homes have appreciated by 2, 3, 4%, or even more in recent years every single year. So this means that the longer I stay in my home, the more the value will increase. And at the same time, the more payments I make on the home, the amount that I owe will decrease, therefore increasing my equity gap. So the way to build equity the most, make payments to pay the debt down, and also to continue to live there and let the value of the property go up. Therefore, that will increase your equity amount. One final way to increase your equity is to refinance into a lower interest rate. One way to do that would be, let's say that an average rate is around 6% and you refinance down to a 5% rate. Well, now the amount that you owe the bank on a monthly basis is lower. That allows you to either take that difference and either apply it towards savings or house renovation, or even send it in to pay down the principal amount you owe on the bank, so therefore you're paying the debt down on that property faster, in turn building more equity. Now there are some ways that you can lose some equity, and I want to get into those real quick as well. So one way, talking about refinancing, is if you take money out of your home. Now this is super tempting for a lot of people, but with how home values have shot up in recent years, some people will say, hey, I bought this house for $300, now it's worth $400, and I want to refinance and take out some of that equity that I've got. That's certainly their decision to do that, but just know that whenever you do that, you're pulling the equity out of the home and getting it in the form of liquid cash, which is wonderful for the bank account. However, it puts you at a little bit of risk. And the reason it puts you at a little bit of risk is because now you have a higher payment that you have to maintain, which could potentially open up for risk of default or, heaven forbid, even foreclosure. So I want to talk just a little bit about a second mortgage or a refinance. If I get a second mortgage on the home, going back to our example where I bought the home for $300, it's now increased to $400,000. I can either get a second mortgage on that difference of equity, that's called a home equity line of credit, or I can simply refinance the entire $300 plus a little bit more into one loan. There's not really a preference of one or the other, but this time we're seeing a fair amount more people keeping their existing loan in place because it's at a lower interest rate. So for example, if I borrowed money at $300,000 at say a 3% interest rate in the past few years, and I want to get some of my equity out, I'll leave that loan in place and take a second equity line of credit out that's at the higher rate. In this example, the higher rate is only on the additional money that I get out on top of the $300. Where if I refinance the entire portion of it, that $300,000 with the low rate goes away, and now I'm borrowing a big lump sum. All of the money is at the higher interest rate. So in some cases, it is a better scenario for you to leave the existing mortgage in place and borrow on a second mortgage or a home equity line of credit. One final way to lose equity in a property is to not keep up with deferred maintenance. Sometimes we see, whether it's in regards to changing out HVAC filters, making sure that the landscape and shrubbery stays pruned, or even to make sure that the termite bond is renewed and active so there's not termites eating your house. Some of these ways are ways that deferred maintenance can creep into an equity problem with a house. So for example, if my home is worth $400,000 and I owe $300, in this scenario, my home may only be worth $375 or $360 because I did not maintain it well. And even though my payment is going, or my mortgage amount is going down, I still may have negative equity because of deferred maintenance. So why is equity so important? It's really the American dream. This is why people own homes. First off, it's increased net worth. Let me give you an example of that. Let's say, for example, that I bought my home at $400, it approves in price up to $500,000, and at that same time, I'm continuing to pay it down. All of this equity, if I were to sell that property, would go directly to my net worth as an individual, which allows for me and my family to be able to have more money to put down on another home or to pay bills or student loans or whatever it may be. This is the reason that the average homeowner is worth 43 times more than the average renter. The other reason that equity is so important is because of the flexibility to borrow. Let's say, for example, that I need to borrow money for some life circumstance, whether it be a wedding, a children's wedding, their college bills, medical bills. I have the flexibility to do one of these equity lines of credit to be able to pull that equity out and give me the flexibility for me to not have to use money in the bank, but instead my equity to pay whatever bill it may be. The other reason equity is so important is that this is a future retirement. If I continue maintaining my home and trading up into other homes, that will set me up perfectly for retirement in the future. So in conclusion, Equity is awesome. The more equity, the better. And if you want to determine how much equity you have in your home, we can help you with that. We are real estate professionals that are very aware of all the local market trends and what homes sell for, and we can help you run an equity calculator on your home to determine what it would sell for versus what you owe and how much you could put in your pocket after all costs are paid. If you want to give us a call or simply click online at jeffcookrealestate.com, we will be happy to help you determine what your equity is on your home. Like and subscribe for more videos. This is Jeff Cook. We'll see you soon.